So let's talk about the markets from last week and, of course, get a sense of how the markets will be like for this week with Wale Olusi, who's an investment analyst with AfriInvest. Good morning to you, Wale.
Good morning, Harriet.
It's great to have you join me on the program. Let's talk a little bit about what actually shaped investor sentiments last week. Coming from the equities market now, most of the companies that were expected to turn in their results for 2016 are still yet to do so. What actually drove investor sentiment in that segment of the market?
Okay, thank you for having me, Harriet. I think the equities market, the sentiment remained the same from what we saw in the previous week. Investors have continued to use for the banking stock and some insurance stocks rather than the industrial goods stocks and the stocks from the consumer goods sector. I think sentiment is largely driven by the fact that expectations surrounding what the consumer goods and some of the industrial stocks will be turning out by full year earnings period are not going to be great. So this low expectation is driving investors away. For last week, we saw a lot of sell-off on Nigerian berries and Nestle, and that has continued in the last 2 to 3 weeks now, because I think some major investors from our conversation with the traders, we heard that some foreign stakeholders are actually moving out because they don't think the results might be, maybe the results won't be as great as they thought. I mean, there's the FX challenges and cost pressure across lines, and their favor are largely in tier 1 banks, the likes of GT and, Access, UBA, who might, come out with surprises because of the fact that, foreign exchange pressures are largely in their favor, and the fact that they can easily make a lot of spread on the current sentiment in the fixed income market. So I think that's still what is driving sentiment. We don't expect this to change in the interim, and we think the market might still remain soft this week.
But then for the fixed income segment of the market, that saw a lot of activities. If you listen to me, I talked about the Debt Management Office holding its second bond auction for the year, and then the Central Bank of Nigeria held Treasury bills auction. So there was a lot of liquidity, even though there was an immediate, mopping up by the CBN. But talk to us a little bit about investor sentiment in this segment of the market. It still seems as if that's the place to go.
Yeah, I think what is happening in the fixed income markets right now is the fact that the yield environment is so attractive. Everybody wants to do it. From our end here, we've been getting a lot of interest from investors who want to do T-bills at the moment. So looking at the risk environment, the equities market is largely unattractive. And the yield environment in the fixed income market, T-bills most especially, the 365 days instrument is going for about 18% plus. A lot of investors want to do this at the moment because of the rate. Most of the T-bills instruments that were issued last week were oversubscribed, and at some point, government had to over-allot what was happening there because the rates were favorable, and they aren't even as high as they wanted to, bring it out initially. So despite liquidity mop-up, we also saw some inflow coming in from FARC allocation. Some 400 billion naira was allocated for FARC last week, but about 200 billion came into the market as a result. But the mop-up also kind of moderates system liquidity. So largely, liquidity makes it attractive yield to continue to drive what is happening in the fixed income segment of the market. I think DMO also, issued the February edition of their rollover for 2021 instrument as well as the 2036 instrument last week.
But while coming into this week, it's a very busy week for the markets and for analysts at AfriInvest. I'm sure it's going to be one to really keep your eye on. FMDQ, OTC, and the Nigerian Stock Exchange will be admitting Forte Oil's 9 billion naira corporate bond. It's the first corporate bond for the year 2017 for both exchanges. Talk to us a little bit about this. What does AfriInvest think?
Well, we think for the corporate bond environment, largely investors have rather favor the sovereign bond because they are more attractive, and the overall risk environment is not so much in favor of corporates at the moment. for some of the banks, some of them had their rating downgraded last week, as we saw. And for the likes of 40 who are exposed to activities in the oil space, investors are probably still worried about the likelihood of them meeting their obligations in terms of coupon. But what we are seeing now is a listing of an existing bond. So what you will see investors do is to ask for more premium on such bond, looking at the overall risk environment. So now that government bonds are more attractive, and I'm probably going to get more for doing a government bond because is a less risky investment versus corporate, who may be challenged by a lot of pressure coming from costs, coming from financing these debt instruments, as well as their profitability. So before I want to, put my money in a corporate bond, I probably want to look at the risk profile and the credit profile of many of these companies. But I'd rather do a government bond who can easily roll over and, support these debt instruments with non-oil revenue coming from tax, and they can do it for as long as they want, as well as oil revenue, which they depend so much on. Even though the outlook on that is not as great as it used to be, but the risk environment is still a little bit in favor of government rather than corporate.
So which means at least, so speaking from AfriInvest's perspective now, you're expecting more investors to favor federal government bonds as against corporate bonds, at least for the first half or for most of the year.
Yeah, that's correct. We have seen this since last year. Even in the Eurobond environment, yield on federal government Eurobonds are a little around 6%, but for the corporate bond is about 10%. So what that implies is that they think it's more risky to, buy some of these bonds because of the risk environment. So the favor has largely been for the federal bond, and it's going to continue for most of 2017 because, really, from the economic perspective, nothing has changed.
All right. Wale, thank you so much for your perspectives. This morning, Wale Olusi is an investment analyst with AfriInvest, giving us a review the markets, and of course, given his own perspective and AfriInvest perspective on expectations with regards to corporate bond of that's 40 Oil's 9 billion naira corporate bond that will be listed on the FMDQ OTC Securities Exchange and the Nigerian Stock Exchange